Hi, I'm Louise. Which Genting counter is most worthy to be invested? Profit and dividend distribution. Between financial year 2012 to 2021, the profit after tax of Genting Berhad and Genting Malaysia have been trending downwards, while the profit after tax of Genting Plantations has been fluctuating. Likewise, it is shown in this figure that between financial year 2012 to 2021, Genting Plantations' earning per share was fluctuating, while the earning per share of Genting Berhad and Genting Malaysia was decreasing over time. In particular, in 2020 to 2021, due to the COVID pandemic, Genting's casinos and other resort facilities were closed temporarily, which led to lower income and severe losses. In the last few years, the dividend yield of the three Genting counters mostly ranged between 0.5 to 4%. By comparing the average dividend yield of the Genting counters, it is shown that on average, Genting Malaysia had the highest dividend yield at around 3.5%, while the other two counters' dividend yield was around 2%. Dividend payout ratio indicates the proportion of net profit being distributed to shareholders in the form of dividends. In the last few years, the dividend payout ratio of the three Genting counters has been inconsistent, mostly ranged between 10 to 80%. Management efficiency. Between financial year 2012 to 2021, the Genting counters' net profit margin mostly ranged between 5 to 20%. In 2020 to 2021, both of Genting Berhad and Genting Malaysia were losing money, so their profit margin dropped to negative values. By comparing the average net profit margin of the Genting counters, it is shown that on average, Genting Plantations has the highest net profit margin at around 15%. It appears that Genting Plantations' profits has not been significantly impacted by the COVID pandemic, so it could achieve a higher average net profit margin. Figure shows that during this period, the return on equity of the three Genting counters mostly ranged between 4 to 8%, which is relatively low, indicating that the large amount of assets have not been utilized effectively to bring in more profits for the companies. Likewise, in 2020 to 2021, Genting Berhad and Genting Malaysia were making losses, hence the return on equity were shown to be negative. By comparing the average return on equity of the Genting counters, it is shown that on average, Genting Plantations has the highest return on equity at around 6.5%, while the other two counters' return on equity were around 4 to 5%. Genting Plantations' profits has not been significantly impacted by the COVID pandemic, so it could achieve a higher average return on equity. Figure shows that in the last few years, the three Genting counters' return on assets ranged between 1 to 5%. Again, the values are lower than expected, indicating that the large quantity of assets have not been utilized effectively to increase profits for the companies. By comparing the average return on assets of the Genting counters, it is shown that on average, Genting Malaysia and Genting Plantations had the highest return on assets at around 3.5 to 4%, while the return on assets of Genting Berhad was around 1.5%. Stock valuation. Between financial year 2012 to 2021, the total assets of all three Genting counters were on an upward trend, and Genting Berhad had the highest amount of total assets. Net tangible assets is equal to total assets minus the total liabilities. It is shown in the figure that the net tangible assets of the Genting counters are mostly constant over the years. This indicates that while the total assets of the companies are increasing over time, the company's debt level have also been rising in a similar pace. Between financial year 2012 to 2021, it is shown that the share price of all three Genting counters have been trending downwards. Among the three counters, Genting Plantations has the highest share price. Price to book ratio is calculated by dividing share price with net tangible assets per share. Lower price to book ratio, especially lower than 1, is preferable. This shows that the share price is undervalued and has room for upward movement and worthy to be invested. Between financial year 2012 to 2021, it is shown that the price-to-book ratio of all three Genting counters have been decreasing with time, indicating that the share price has become cheaper over time. In particular, the price-to-book ratio of Genting Berhad is currently at only 0.6 times. From this perspective, the share price appears to be undervalued. P/E ratio is calculated by dividing share price with earning per share, which shows the ratio between the share price and the earnings of the company. If the ratio is very high, it shows that the share price is at a high point, which is not worthy to be invested. Between financial year 2012 to 2021, the P/E ratio of the three Genting counters mostly ranged between 10 to 40 times. As mentioned before, Genting Berhad and Genting Malaysia were losing money in 2020 to 2021, so the P/E ratio is shown to be negative. The market cap is calculated by multiplying share price with the number of shares. Hence, higher share price will contribute to increasing market cap and overall valuation of the company. It is shown that during this period, the market cap of Genting Berhad and Genting Malaysia have been decreasing over time, indicating that investors are lowering their valuation on these two counters. On the other hand, the market cap of Genting Plantations has been mostly constant. By considering the number of shareholders holding the stock, there has been no significant growth trending on the number of investors for Genting Plantations. Conversely, it is shown that Genting Berhad and Genting Malaysia's number of investors have seen a significant uptick since 2017. This may be due to the gradual decrease of share price, which attracted the interest of more investors. In financial year 2021, Genting Malaysia is the most popular Genting counter, having the highest number of investors. Financial management and stability. Between financial year 2012 to 2021, it is shown that all three Genting counters have been consistently investing capital expenditure to further develop its business. These capital expenditure spending are mainly used for building or expanding Genting casinos, theme parks, hotels, and other resorts facilities, while Genting plantation spending is mainly used for replanting oil palm trees and building new oil mills. Equity to liability ratio is calculated by dividing total equity with total liability. If the ratio is above 1, it is shown that the assets level of the company is higher than its debt level, indicating that the company's finances are stable. As shown in the figure, the equity to liability ratio of the three Genting counters are above or close to 1, indicating that their debt is relatively low and their finances stable. Current ratio is calculated by dividing current asset with current liability. If the ratio is above 1, it is shown that the short-term assets level of the company is higher than its short-term debt level, indicating that the company's finances are stable. Between financial year 2012 to 2021, it is shown that the current ratio of all three Genting counters are above 1, indicating that the company's short-term debt level have been low and they are having enough funds to pay off their short-term debts. Between financial year 2012 to 2021, it is shown that all three Genting counters have a significant amount of cash flow reserve, indicating that this company's finance is on a stable footing. By considering the company's cash flow per share, it is shown that Genting Berhad has the highest cash flow per share, which is even higher than the company's share price, which shows that the company is having sufficient amount of cash reserve. Genting Berhad as the parent company has a huge scale and its business operates in various sectors and countries. As subsidiaries under Genting Berhad, Genting Malaysia and Genting Plantations are smaller in scale. Genting Malaysia mainly operates casinos, hotels, and theme parks, etc. in Genting Malaysia, while Genting Plantations owns a large area of oil palm plantations, consistently producing crude palm oil and refined products. Genting Berhad and Genting Malaysia have been affected by the pandemic in the past 2 years, losing money in this period. Now that the pandemic is under control, it is estimated that they can gradually return to profitability. The profit of Genting Plantations has not been seriously affected by the pandemic. The recent rise in palm oil prices has also increased the company's profit. However, future profits will still be affected by oil prices, which will continue to fluctuate and have certain risks. By considering the dividend yield, it is shown that currently Genting Malaysia has the highest average dividend yield at around 3.5%, while the other two counters average at around 2%. All three Genting counters have PE ratio ranging from 10 to 40 times, which indicates that both of the profits and share prices fluctuate over a wide range, which could be a source of risk for investment. Based on the info presented in this report, have you made up your mind which Genting counter do you think is most worthy to be invested in? That's all for today. Feel free to share your thoughts in the comment section. See you next time. Bye. The content above is for sharing and reference purpose only. It is not an investment recommendation. Investors are encouraged to carry out further research and analysis as well as follow up latest update information before making any investment decisions.